51 should take you to fair value. From a fair value, 51 more points should take you to a discount. So from a bottom edge, 51 points should take you to fair value, and 51 more points should take you to a premium. So when you're looking at ranges, make sure you write down these ranges and keep them in your charts, because this range is valid for the next 0.32 days. In other words, it expires today. Okay, so this is today's expiry. So this range is valid for today. So make sure you're always watching these, because they are updated. They are valid. And obviously, if you're looking at that from the S&P, you can do the same on gold. You can do the same on oil. Make sure you don't lose track of the size of that range. Now, some might say the S&P with a range of 51 points. Yeah, because the market's been really volatile. You know, and 51 points might seem in the face of it to be too large a move. I mean, you're looking at a huge change for that to be a real thing, right? So the high swing was, of course, 83. So obviously you're going to be looking around about the 30 price level at the moment for the swing low. So obviously you just mark it on your charts, guys. Just mark that swing low currently on your charts and say, right, well, we can always update it. As the time passes, those ranges will probably narrow, as you would imagine, because volatility reduces with time. And, you know, as the price starts to narrow, then, of course, that's you. You're good to go. Now, from the bottom edge, the same is true. So if the bottom edge was at 50, which it was, that's the London kind of session low is 59.50, and we're 51 points higher. Well, obviously, if we're at 59.50 and we're 51 points higher, then the top edge should be actually targeting around about 6,000 now. So you've now got your range on the S&P, haven't you? You've now got that piece of information clear on your screens here. So you know where the range low is at the moment. You know where the range high is at the moment. And of course, you know, the difference between those two prices should be, you know, obviously, you know, looking at where the swing low was to the high and where the swing high is to the low, right? So there's not going to be a relationship between these two prices. The relationship is where the swing low was plus volatility, and swing high is minus the volatility read. And if you do that on your oil, if you do that on your gold, then of course life becomes that little bit clearer in terms of ranges. So let's take a look at oil as it stands at the moment. Obviously, we'd sold short oil as we talked about this morning in London. What's the oil range today? Well, let's take a look at oil. Again, you're looking for that 0 days to expiry. And all you're looking for is the top box levels. And you can see it's 80 cents, 80 cents, and 80 cents. So from the swing high, it's 80 cents. From the swing low, it's 80 cents. Middle price, it's $1.60. Okay, about $1.60. So you're going to be looking at that and saying, right, 80 cents from the top edge, which obviously is just under 80. So obviously your range is around about what price? 71.90, correct? 80 cents, 71.90. Does everybody agree with that? So where did the buy bounce come in? 70.90, didn't it? So we went from 71.70s and we took 80 cents off it, and we've targeted 70.90, and we've hit 70.90, and as soon as it hit 70.90 fair value, the price bounced. It was almost perfect, wasn't it? And obviously, if you're going to then make the range extension from the highs, you can then obviously just do the measured move on that and say, right, well, realistically, at the moment, that's the range extension from the highs. Which, if you think about where the range low was, which was 8 o'clock yesterday, obviously the range high and the range low is the same price effectively now, isn't it? So you can recognize that that's probably realistic about where they're estimating. And remember, this isn't based on price action. This is real money pricing. This is real model pricing. This is based on models that have won Nobel Prizes in economics. So this is not something that is just some sort of retail fanciful idea. This is Nobel Economics Prize winning stuff here. And you're just using it to make sure you kind of understand the volatility ranges that are currently trading. Now, remember, they don't stay static. These ranges will reduce as time passes, and you should always be ready to reestablish. Always get ready to reestablish. Some people like to put it on the POC and say, well, what's the POC? The POC is where you would imagine is fair value. Some people like to look at the current price and say, right, what's the current price versus the range? Well, the current price versus the range is about right here because that's the range low, that's the current price, and therefore this range is now probably very accurate as far as where the range is extending from and to. So just make sure you don't lose sight of the value of the range information. It's easy to see where the dealer keys are, where the dealer key levels are. And obviously, if you trade those dealer key levels, then you should be in pretty good shape in these range areas. How good was the sell on bonds, guys? Anybody take it? I told you if it pulls back to 20, we were going to sell it. Did I not? Tell you if it pulls back to 20, we're going to sell it. Yep. So how did it do? Okay. So this is what happened. So we told you a while a while ago if it goes back to 20 here, we're going to sell it. It came back to 20 right there. And there was a very nice sell. It's gone all the way down to 1922. We started to see a bit of divergence creeping into this as well. It is into day session lows. Great place to book some monies. What a lovely little live room trade. Yet again, right-hand edge stuff, guys. Nothing to do with hindsight stuff, that was it, because we called it in advance. We said if we get back to 120 evens, we're going to be looking to go short this bond. And that paid out very, very nicely for you. Thank you very much indeed.